Adjunct Professor Moran, Macroeconomics 111. In our last session, we introduced the concept of aggregate expense model, and we discussed consumption. We decided the most important determinant of consumption was disposable income, and that when your income went up, so did your consumption. In this session, we're going to calculate savings. We're going to calculate average propensity to consume, average propensity to save. The point of that being to indicate that we are not going to use that going forward. We're going to use another statistic called marginal propensity to consume and marginal propensity to save. Now, we have no income, yet you're spending $2,000. That's called dis-savings. You're taking money out of an account, a bank account. Your income is so low that it doesn't cover your consumption. 2,000 minus 3,600, your income rises to 2,000, your consumption rises to 3,600. You are dis-savings 1,600. Your income rises to 4, your consumption rises to 5,200. You are dis-saving 1,200. Income rises to 6, consumption rises to 6,800. You are dis-saving 800. Income rises to 8, consumption rises to 8,400. You are dis-saving $400. 10,000 minus 10,000 is 0. This is break even. These are dis-savings, and this represents savings of $400. Now we can calculate the average. To calculate the average propensity to consume, you take consumption divided by income, but you can't divide a number by 0. Take consumption divided by income, and you're consuming 180% of your income. You are consuming more than your income. 5,200 divided by 400 is 130%. 6,800 divided by 6,000 is 113%. 8,400 divided by 8,000 is 105%. Break even is 100%, and 400 divided by 12,000 is 97%. There are two ways of getting the average propensity to consume once you have the average propensity to save, once you have the average propensity to consume. Since you can only have 100% of something, you can subtract average propensity to consume from 1, which would give you an average propensity to save of minus 180%. Minus 30%, minus 13%, minus 5%, 0, and plus 3%. This would be minus 80. This has to add up to 1. So plus 180 minus average propensity to save of 80 would give you 100. 130, and I just did what I told you not to do. This is actually a plus. So you only have 100% of something. A positive 180% average propensity to consume minus 80% average propensity to save gives you 100% income. 130 minus 30, 113, 13. Now, notice all the information comes from one line. That's an average. And we don't want to know that, because if there's a tax cut, we can't really tell from an average how much of that tax cut you're going to change, because it's a snapshot in time. Instead, we want to do something called use this is called marginal propensity to consume and marginal propensity to save. So, again, we'll practice. 10,000 income minus consumption of 12,000 gives dis-savings of 2,000. Dis-savings of 1,000. 30 minus 30, here we have break even. Now we have 40 minus 39, we have savings of 1,000. 50 minus 48, we have savings of 2,000, 3,000, 4,000. The average propensity to consume, consumption divided by income, 120%. 21 divided by 20, 105%. 30 divided by 30, average of 0. 39 divided by 40 gives you an average propensity to consume of 98%. 48 and 50 gives you 96% average propensity to consume. 95%. 66 divided by 70 is 94%. So average propensity to save would be a negative 20, a negative 5, 0, plus 2, plus 4, plus 5, plus 6. Average propensity to consume, average propensity to save adds up to 1. You only have 100% of something. Now, in order to calculate a marginal propensity to consume, how likely propensity are you to consume an extra marginal dollar? You need to have a change. So, how much is income changing at each one of these levels? Well, it's changing by 10. So it's customary to go draw a caret. Since you need a change, it's not either on this line or this line. 20 to 30 is 10, 30 to 40 is 10, 40 to 50 is 10, 50 to 60 is 10, 60 to 70 is 10. Well, how much does consumption change every time income changes by 10? Well, that looks like 9,000. These are in thousands. 9,000, 9,000, 9,000, 9,000, 9,000. It's the same because the consumption function is a straight line, and the slope of a straight line is constant. So it doesn't matter where you take the difference, it'll always be 9,000. When income changes by 10,000, how much does savings change by? Negative 2 to negative 1 is 1. Negative 1 to 0 is 1. 0 to 1, 1 to 2, 1 to 3, 1 to 4. The saving schedule is also a straight line, and so it will always be the same. Now, the marginal propensity to consume is the change in consumption divided by the change in income. 9 divided by 10 is 0.9. And again, since this is the slope of the consumption line, so this will be the same. And 1, the change in savings divided by the change in income of 10 will give you 0.1. That's the marginal propensity to save. Every time you receive an extra dollar of income, you'll spend 90 cents. Every time you receive an extra dollar of income, you will save 10 cents. These are the numbers that are going to be very important for us to use going forward, because the government will alter taxes, for example, in order to supplement your income, which then you will take that change in income and spend part and save part. And that change in spending will either be expansionary if they decrease your taxes and fight a recession, or if they increase your taxes, will be contractionary, meant to fight inflation.